Friday, September 9th, the markets were down big with the Dow and S&P 500 both down over 2% for the day. Even though the markets had a big down day, I was still kind of surprised how bearish the sentiment was that I saw on different media channels regarding the markets. And then I saw this headline on CNBC where halftime trader John Najarian reports that he's sold all of his positions. And this reminded me distinctly of the only other time I recall this happening, which was back in 2012, where I remember this specifically because he called out how he had never been completely out of stocks for 31 years in the market. And at the end of 2012, due to the fiscal cliff, he decided to sell all of his positions. And I remember CNBC really kind of playing this commentary up like it was a big deal. And I really specifically remember the CNBC fiscal cliff countdown in December 2012 and how they were like really drumbeating that it was going to be a big issue and really cause a lot of distortions in the markets. And I actually had somebody from a radio show call me up and do an interview with me, and they were basically feeding me questions like regarding how the markets were going to be unstable to start 2013 and how things were, potentially going to go sour. And I remember saying that he actually, technically the markets weren't in a bad position. And looking at the charts, in 2012, actually, what happened was, we had the mini bear market in 2011, which ended pretty abruptly, and then the S&P 500 rallied back above the 30-week moving average in 2012. But then we had two specific corrections to the 30-week moving average during 2012 as this rally kind of was getting started. And really, at the end of 2012, when the fiscal cliff worries were starting, was where a lot of people were still pretty pessimistic about the market. But really what had happened over a period of about 2 years was the market had essentially just gone sideways and really worked off the major rally that the markets had from 2009 through 2010. So the market was essentially digesting the major gains it had for 2 years, which set the stage for the 2 year, epic surge bull market that we had from 2013 into the middle of 2015. So this is an example of how, kind of a sideways bear market, which was punctuated by, kind of a couple different down moves in 2011, really, returned sentiment to a position where the market was able to rally again in a stage two advance. And new leadership sectors are really what powered this bull market advance, which was powered by things like biotech and new IPOs like Tesla. So, and what's actually pretty interesting is that, the Nigerian sell everything point was really right at the end of that bear market, where actually we'd already gotten back into stage two, but it was kind of a slow start. And once we like kind of retested this former resistance area that became support, it was off to the races. And now what we have here in 2015 and 16 is kind of the same situation where the market rallied hard for 2.5 years, and we get the sideways bear market for almost 2 years, punctuated by a couple different major corrections that didn't morph into stage four downtrends. And as the market made a bottom again in early 2016, it rallied up, held support here at the 30-week moving average, and then is potentially, off to the races in a stage 2 bull market. And, he's selling everything right here, which is kind of like the same position the market was in right here, where maybe it goes down and retests support, or, former resistance that's become support, and then bounces off it, and we get this resumption of the stage 2 bull market. So a couple of points about really where we are, in the markets, is that earlier, at the end of last year, I was more kind of mixed and slanting towards being a market bear, because we had a stage 4 breakdown, which the market rallied up and had that perfect. The best place to short the market in a stage 4 bear market is actually where the market gets above the 30-week moving average, but the moving average is sloping downward, which signifies that this becomes resistance, and it's a good area to short, because you get these quick plunges in the market, and the best time to get short is when you have good risk reward above the moving average before the market makes its next plunge. Well, this perfect setup actually happened at the end of 2015, but the market negated the bear market in February of this year, and instead of continuing on into stage 4, we got a bottom. The market rallied higher, and then the key retest was in May and June, where the market had the opportunity to potentially top again, but instead it found support, and we've pushed higher again, which is now forming a new stage 2 advance. So until the bears can really close this market back below 2050 and like around 2000 on the S&P 500, there's just not a lot you can say for the bear case, because the market is clearly pushing into a new stage 2 advance. And really, even though we had a monster down day on Friday, the structure of the market is still very much in a stage 2, and we can go all the way down and get to like 2100 and lower on the S&P 500, and even down to like 2050, and still kind of be in the stage 2 and still holding support, which was formerly resistance. So a lot of more damage has to occur for the market to weaken enough to where the bear case comes back into play. And even if it gets down there, we need to see what would happen on the next rally. If it stalls out, then the market really would be setting up maybe another top and a potential move back into stage 4. Now, looking at market breadth, one of the things that was holding the market back earlier in the year was that even though the market was kind of moving sideways, the percentage of stocks in stage 2 was quite low, and actually a large percentage of stocks in different indexes were in stage 4. But really, that's not the case anymore. And actually, the foreign markets, along with the emerging markets, which were one of the weaker sectors to start the year, have actually flipped and now are one of the stronger portions of the market, which is actually very significant, because a lot of the weakness in the markets to start the year was in the foreign developed markets. And now you can see on the Sage Analysis screener that 87.5% of foreign ETFs in this group that I have here are in stage 2. And likewise, even after Friday's plunge, we still have 63% of S&P 500 stocks in stage 2, and 80% of the Dow Jones stocks are in stage 2. And you can see the low percentage of stocks that are in stage 4. Now, this will increase if the market does fall again, but again, until the percentages start swaying more heavily towards stage 3 and 4, there's no reason to believe that the stage 2 advance is over. Another thing that really was a precursor to the stage 4 decline that happened leading into early 2016 was the weakness in the junk bond markets and even the high yield or high grade bond markets, but the junk bonds moved into a stage 3 top in late 2014 and then fell back below the moving average in mid 2015 before the market started plunging in August. And they really continued their plunge all the way into early 2016. But instead of this stage 4 bear market continuing further, it actually bottomed and reversed. And even though it had this rally, if it would have failed around here and then moved back lower into the stage 4 again, that would have been a negative sign for the markets. But notice how the junk bonds proceeded to find the 30-week moving average as support and then rally further, which confirmed that actually this market had moved back into stage 2. And notice how the volume on the junk bond ETF was about 2 times average volume during this retest of the 30-week moving average, which is a good sign for a stage 2 bull market. So really the bad credit conditions that punctuated the kind of onset of this 2014 to 15 bear market came to an end essentially in February of 2016. Another big negative part of the market was these foreign European banks. And here's an example of a bank that actually, a lot of focus has been on banks like Deutsche Bank, HSBC, Barclays, where they've been in these epic stage 4 bear markets and looking quite terrible. But you see this stage 4 bear market that actually, finally put in a base during this year, and with all the negative attention, once the pressure on the bear market started to alleviate itself, all of a sudden this bank that's been crushed is actually back into a stage 2 breakout mode. So this is again a sign that the negative forces working against the market have alleviated to the point where even a bank with super poor fundamentals is actually moving back into stage 2. One final example is the London Financial Times Index, where a lot of attention has been focused on the Brexit and kind of the negative economic situation in Europe and in England. But here you have a market that's been really in kind of a stage 3 topping process for almost 4 years now, and as the stage 4 bear market kind of progressed from early 2015 to early this year, all of a sudden we had a bottoming process and then another bottom during the Brexit, and then once the pressure is alleviated, all of a sudden you find this market back above the 30-week moving average. So here's another case where a market that formerly had been in a bearish structure for a long period of time finds itself moving back higher when conditions are slowly improving and actually markets are actually moving into more of a bullish configuration. So really the bottom line, as I said before, is that even though we've kind of been in this sideways bear market now for almost 2 years, at this point we still, for the bearish case, we still need to see the market really close back below these levels that are now support to really get back and focus on the bear side again. Otherwise, this can just be viewed more as a market correction that was overdue, which will set the stage for the continued stage 2 advance.